We are live.
Yes.
Hello. Hello, all you cats and kittens. Little joke for all of you tuning in from home. Welcome. My name is Courtney Lohmann. I'm the Senior Director of Alumni Engagement at St. Mary's. Thank you for tuning in today. This is the second event of our 5-event series. At the beginning of quarantine, it was going to be 5 events. Now, who knows? We're gonna keep them coming. But we're excited to be here today with you, and we're glad you're tuning in. We're gonna give people a few minutes to get live with us, and then we'll get started. I'll introduce our speakers. Till then, thank you guys for being here with us. Toussaint.
Absolutely.
You're welcome.
We're still, bear with us through our technical issues. This is our first live with multiple speakers going. I'm sure by 6 months into quarantine, we'll have it all seamless.
6 months. No, 6 months.
Hopefully not. Hopefully we don't get that far.
Right.
All right. Well, as people are hopping on.
Let me see. Let me make sure I can see you too.
How is life for you guys working from home?
Not terrible for me. I'm seeing a whole lot more of the kids, doing some walks around the neighborhood, mostly having some fun. So I can't speak for my Denise, my wife, who's also an alumnus, but good for me. We're partying.
Yeah. I was gonna say it's probably the same thing. Lisa is also a class of 02 from St. Mary's, my wife, and we have 3 daughters. So we live in Truckee, but have a little place down in Palm Desert. So we came down to Palm Desert to quarantine, and the 85-degree weather is definitely a reprieve, put it that way.
Yeah, that sounds nice.
And there's DoorDash down here and all that.
So you weren't loving quarantining in the snow with no skiing?
I don't think so. Not with walls of snow. So yeah, no.
Nice. Yeah, it's an adjustment, but everybody seems to be picking up quick and getting ready. So I'm glad we're able to do this. Toussaint, you've been on our alumni board for, it's your 6th year? 6th?
Yep, 6 year. 6 year. I think I term out this year.
Oh, that's sad.
Yeah.
My go-to, whenever I have a crazy idea, first person I go to is Toussaint.
The crazy person. That's right.
Hey, we got to do some events online. Come on. Let's
do it.
Let's do it.
Give us a week. I'll call my crazy person, Jimbo.
All right. Well, let's go ahead and get started. I'm going to introduce you guys with all your amazing biographical information, and then I'm going to duck out of here and let you take over. They will tell you guys a little bit about themselves too, but we also have some questions that we collected when people were RSVPing. You can submit questions as we go through this session as well, so feel free to do that. But let's go ahead and get started. So Jim DeCota is the president, and Toussaint Bailey is the CEO of Enso Wealth Management, a registered investment advisor firm managing over $1 billion for clients throughout the Bay Area, Northern California, and all the way up into Reno. Jim graduated from SMC in 1999 with a degree in accounting and began his career as an accountant before becoming a financial advisor in 2002. He founded this firm in 2014 with the mission of translating wealth into fulfillment. This remains Jim's personal mission and became the mission of Enso Wealth as a firm as well. Jim serves clients through holistic wealth management approach, including financial planning, investment management, and relationship management, grounded in his technical understanding as a former accountant and student of current industry trends. Toussaint graduated from St. Mary's in 2002 with a degree in business and honors concentration in financial services. He went on to law school at UCLA shortly after St. Mary's and practiced law for over a decade before leaving his partnership to take over as Enso Wealth CEO in 2017. Although he no longer functions as legal counsel, Toussaint still considers himself a counselor first. He enjoys distilling complex concepts down to simple conversations and helping clients filter the noise to hone in on what truly is most meaningful in their lives. We're so grateful to have you guys both here sharing your knowledge and expertise with our alumni community. So with that, I'm going to bow out and let you all take over.
Thank you.
Thank you, Courtney.
Yeah, I think there's a little bit of a delay on for the YouTube stream. So just as I watch it, so.
Yeah, so if I were you, Jim, just mute the YouTube.
Yeah.
And then
No,
just speak to this one. I'll just kind of check over on the YouTube channel every once in a while for chat questions, etc. As I'm sure you all can probably sense by now, this is just kind of a very informal conversation. Jim is my brother from another mother, literally. Been friends for 20 years, so we talk over one another. We'll kind of go back and forth. We call it skit scatting and bebopping. So there'll be a lot of that. No, there are several people on, probably several different financial situations. So what we'll try to do is be broad enough that we're giving information that could help everyone, but specific enough that we actually say something useful. So chime in with chat questions as we go along. Let us know whether what we're saying is helpful, whether you need us to drill down on anything specifically. We called this money therapy, mainly because what we're going to be trying to do is just give perspective. We're going to answer specific questions, but with every question as we go through and respond to specific concerns, hopefully we'll be just kind of providing a broader context. We are not going to solve your financial problems in a 30-minute to an hour conversation over Zoom, but we can hopefully get you started with kind of taking on the right paradigms, starting to ask the right questions to your financial professional if you have one, or just kind of look at the right things. So that's the goal here. If we do a great job, then you'll sort of have a lens to filter a lot of the noise that's coming in with. So that's sort of the goal. Of course, everything that's out there is not noise. We've been passing around as a firm a memo that was published yesterday by a pretty legendary investor, Howard Marks. And you may not have heard of Howard Marks, but I'm sure many of you, if you're on this call about money, have heard of Warren Buffett. And as we were going through this memo yesterday, I looked at a quote from Warren Buffett that said, when Howard Marks' memo hits his inbox, it's the first thing he reads. And I was going to share with you something that's kind of startling at the beginning of this, because it does give some context to what's been going on over the past few weeks. We talk about tuning out noise a lot, but here there's more than just noise. So he kind of sets the stage and says between February 19th of this year and March 23rd of this year, the U.S. stock market saw the quickest meltdown in history for a loss of almost 34 points on the S&P. And then last Thursday, between last Tuesday and Thursday, it saw its biggest 3-day gain of 17.5% since the 1930s. Of 21 days of trading between February 27th and March 27th, 18 of those had moves of 2 or more percent in the S&P, 11 down, 7 up. And then from March 9th to March 20th, I think investment grade bond issuance seemed inconceivable. But in recent days since the stimulus, we've seen record investment bonds from 49 companies issuing 170 billion investment grade bonds. So there's more than just noise, and that stuff affects us just like it affects everyone else. So I would start by saying we're empathetic to the sort of seesaw and the whipsaw that's going on. But there are things you can do in just about any market. A lot of these things and a lot of these sort of doomsday scenarios we see with every recession, it's sort of tough to see the end of anything, whether it's good or bad. So a lot of what we've been doing with our clients and internally is talking about how to zoom out, how to give broader time horizons, how to think about investments from a broader perspective, and how to sort of keep context around a lot of what you're hearing right now. Some of that involves planning and other sorts of defensive things that can be done in just about any market. Smart planning is smart planning in any market. I know Jim can share with you some of what we're doing for our clients that show up as planning opportunities right now, separate from any specific investment opportunities. There are just things that you can be doing around money in a market like this that are perfect for specifically this market. And
Dude,
Jim, you can share a
wanna,
few of those things.
yeah, okay, I'll share a couple of those things right now. I think one of the, from talking to clients and having been in this industry now for almost 20 years, when the Toussaint just mentioned the numbers, I mean, never in my career or anybody's career has the market dropped 30% in 18 days. And for us as financial advisors, there's this period of time where you almost feel victim, and you're like, okay, like, oh, this is real. Like we have to like engage. And so for me, there's always this, and some of the most well-known hedge fund managers out there didn't even see this, didn't even know, said they missed it for their clients. There's new news coming out now, but they just didn't even know. But I like to take action during this time. I like to feel with clients, I like to feel like we're actually taking control of something, and we're actually moving forward, and we're actually adding value. So the two things that you can do, and granted, the worst advice is free advice, but I think that this advice goes across the board for everyone. It really helps if you had a financial plan before. If you didn't, then you might not know what your proper allocation is. And when I talk about allocation, what I'm talking about is what level of ownership investments do you have, i.e. stocks in the stock market, whether it's through an ETF, exchange traded fund, or whether it's through a mutual fund, and what's that percentage to bonds that you own. And bonds are loanership investments, so there's no equity stake in bonds. You're literally loaning your money to receive interest back. And what happened, and one of the first things that we mobilized to was, if I had a client whose proper asset allocation for their financial plan was 50% in the stock market in ownership investments and 50% out of the stock market in bond investments, and there's a litany of different types of bonds you can own, but if that was the appropriate allocation for their financial plan, when the market dropped as fast as it did, that 50% that was in the market, not all of our clients, that 50% didn't drop all 30%, but it still fell, because in just like 07, 08, and 09, what happened with me is a lot of good quality companies get hammered just because they're in the market. They didn't do anything wrong. There's not going to be potentially any bad earnings. It's just they're a stock in the stock market, and the stock market's going down, which means they're going down. And in a lot of cases, those 50-50 portfolios, the stock portion percentage might have gone down to 45% because the market fell. And then the bond portion of the portfolio went up to 55%. And what you have to do, and it seems so counterintuitive, but what you have to do is that 55% that you have in bonds, you have to sell out that 5%, and you have to buy back into the market. And it seems really counterintuitive. Why would I put money back into something that's doing worse versus something that's doing better? And from a financial planning standpoint, the proper allocation for a successful a retirement, getting into retirement or living through retirement, for that particular person was 50-50. So we need to get back in 50-50. Now, what I'm going to say now, everybody's heard this, but maybe they've never had to do it. Essentially, all we did was sold high and bought low. And that's what you're supposed to do in the market.
Yeah, this concept of rebalancing is what they call this. And that's exactly how I conceptualize it in my head, is a discipline mechanism for making sure, even in markets like this, you are selling high and buying low.
Yeah,
So
and I have, go ahead.
I was just going to ask, and you probably were going to get to this, but can you mention some of the things that you do from a tax perspective, Roth IRA conversions, tax loss harvesting, like sentence or two,
Yeah,
just sort of planning tools to take advantage of where we are, no matter what you think the market's going to do in the next few days or months.
yeah, non-retirement accounts. So no IRAs, no Roths, no 401ks. You should still rebalance those. But one of the only loopholes left for us from an investment standpoint is harvesting your losses. So if you own mutual fund A that is big companies in America, and you have a loss on that particular fund, and you exchange over to a similar mutual fund, let's call it, into mutual fund B, that sale triggers a loss. Now, you're not out of the market. You do it all on the same day. But in capturing that loss, you get to write that off your taxes in the future, along with offsetting it against any gains. So figure every $100,000 of capital loss that you create or you harvest, you're not selling and losing, some clients ask. You're just selling and going right back in the market the same day. For every $100,000, you'll save on average of between $20,000 and $30,000 in taxes. It just depends on the person's tax bracket and where they live in the country. But that is a actionable item that you can do that will add value to your pocketbook down the road.
Yeah, and there's I would say that's all stuff that you would probably work with your financial professional with, or work with wherever you get financial advice. But there's also kind of some personal action items that can help you focus somewhere other than what the S&P is doing or what the Dow is doing. I would say we're all kind of sitting still right now, or the world has slowed down for a lot of people in a lot of professions. This is a great time to look at your budget if you're focused on what the stock market's doing, rather than your sort of personal economy, and knowing how the dollars are going out and being sort of conscious of your spending right now. This is a great opportunity to do that. It's also, an opportunity to look at what resources may be available from a cash flow standpoint. I mean, we're speaking right now to people who may be invested in the stock market, but there's some people who are facing cash flow issues. We've been doing as much work as we can as a firm, as fast as we can, to understand what's in the stimulus package, both for individuals and businesses. There's tons of resources out there, almost too much information. We can kind of help distill some of that, but this is a great time to look at what resources are out there, and be paying attention to money that's coming to and available to a lot of people who money typically may not be available to. Looking at I would say, as a general idea, be paying attention to sort of your personal situation and your personal economy, more so than looking at what the indexes are doing on a daily basis.
Yeah, there's a question that just came through from Zach. It said, would the concept of rebalancing also apply to a target retirement fund? That's a great question. I have an opinion on target retirement funds, but I'll probably save it. Let me answer it this way. What I've done with clients' 401ks, especially those that are 5 years out or more from retirement, is all of their contributions right now are going into the market. All of their contributions are going into the market. When I say market, I mean the stock market. So the answer to, would the concept of rebalancing also apply to a target retirement fund? The target retirement fund is actually doing that automatically. And depending on what target retirement fund you have and how far away you are, they should be doing that automatically. One of the value adds you can do, though, if you're 5 years out or more from retirement, is you can skew your contributions to investing in the market right now, because then you're dollar cost averaging into a market that fell 30% in 18 days, basically. Hopefully that
we have more questions coming through, Jim, and we've been talking a bit. So there's a question that came through beforehand and also now about utilities and muni bonds. Typically, those are a safe haven. There's been talk and pricing in recent weeks around those being riskier instruments. The question is, what is the new risk that COVID presents to these two sectors? That's utilities and munis.
Say it one more time. Sorry, I was reading that.
So I'll read the question. I'll read the question that came through. It says utilities and muni bonds, specifically in California, are generally safe havens, but in recent weeks they have been cut significantly. What is the new risk that COVID presents to these two sectors?
Let's talk muni bonds really quick. There was some fear a couple weeks ago about the ability for muni bond issuer states, municipalities there's a credit issue basically a couple weeks ago, and that's where the run happened. It was actually a temporary liquidity issue, and that's what part of the stimulus is, where unprecedented, where the stimulus is allowing there not to be a liquidity issue. On the muni bonds, I don't really have, I mean, good quality muni bond with a good quality muni bond manager. I mean, the revenue comes from income taxes, real estate taxes, and sales tax. Real estate taxes, I don't think that's gonna go away. I mean, we would be in a really, really deep recession slash depression if that were to happen. Income taxes, I just looked at the numbers, and unemployment hit 10 million people, but there's still people working. There's still income tax revenue coming in. It's not zero like people are talking about out there, along with sales taxes too. I mean, just looking out my window, UPS and FedEx have gone by a couple times. People still are consuming. Yes, it's going to be down, but it's not going to be gone. And I think that's something to take into consideration. The other thing I'd say about utilities is the government just announced, last week announced that you can't get kicked out of your place and your utilities can't get turned on. So that's temporarily unsettling for utility companies, along with apartment complex owners, because is it 1 month? Is it 2 months? So you'll see the market adjust to that for worst case scenario right away.
Yeah. And some of the comments I've heard on the real estate side of that, as well as the utility side of that, is part of those measures are the government attempting to keep people in place. And you would prefer to have people in place from an apartment, a real estate owner or utility owner's standpoint. You prefer to have people in place and paying when incomes are restored, rather than defaulting and getting evicted where they can neither pay utilities nor pay rents. Let's go to another question. There was a question about whether is this a good time to invest in the housing market, was one of the questions that we got earlier. And there was a similar question that we got on YouTube. You wanna tackle that one, Jimbo, and I'll chime in and interrupt you.
You can interrupt me. Forecast for housing. I was reading just some stuff earlier that talked about people who are living in cities are thinking about, if they're under quarantine or this situation happens again, that they might look to move to suburbia. So for me, the forecast for housing in the housing market, I don't think anything's going to change all that much. It was robust going into it. I think we're still in this point in time right now where I think everything around the virus is, are we shut down until the end of May? Are we shut down until the end of July? Are we shut down into the fall? And I think the later that this gets stretched out, that it could potentially affect the housing market. Although it it doesn't seem to have gone that way, where the virus has plateaued. So I guess we just don't really know right now. For first-time home buyers who want to get into the market right now, well, I'll tell you what, interest rates, you're going to have this window of interest rates that is going to provide more purchasing power. So if you were going to buy a house before and COVID came and it's still in your budget and still in your plan to buy a house, I don't think there's any reason why you stop looking to go buy, and especially if it's a long-term investment, right? If you're looking to flip something, then okay, different story. But if you're looking to go purchase a home to live in 5 years or longer, with the interest rates where they're going to be, I mean, I think you got to take a long, hard look at that.
Yeah, I would totally agree about the interest rates, and I would also say, like the stock market, housing, I think it's an unfruitful exercise to guess whether you're at the top or at the bottom. But there's very few times when you're not at the top. And I think this is when we come out of this slowdown, it's not many people are buying much of anything right now. And there's sort of this forced slowdown. When we come out of this, I think you can at least enter the housing market for the first time, which is one of the few opportunities to kind of make money in the housing market on your primary residence. You can enter with the confidence that you're not at the top. So if you're going to buy a house anyway, I would say, yes, it's a great time to, I distinguish consuming house from investing in a house. And if you're buying your primary residence, you're really consuming it, but you're consuming it at a good price.
Yeah. 100%. Yeah. The next question is, it says, I currently don't have access to a 401k nor a Roth. I've been putting retirement cash into a Vanguard taxable account. What are some things to think about and consider as I continue down this path? Well, first off, you should, even if I don't know if you're self-employed or not, but if you are self-employed, then you do have access to a 401k. It's called an owner K. It's a solo 401k. So you do have access to that, but you're still investing money, putting it into a taxable account. Not knowing the situation right now and not knowing how old you are, just things to think about, to consider is, if you're we'll make up numbers. One thing is dollar cost averaging. Continue to do it. If you have been putting money into a Vanguard account, taxable account, like you said, and part of it's been in the stock market, part of it's been in the bond market, I'd probably skew a little bit more towards the stock market right now.
Another question is, any specific suggestions for a new retiree during this time?
Yeah, so, I'll speak big picture for a second. I have had multiple clients retire over the last 4 weeks. And one of the things that I do in my planning is, depending on the person's situation, we have a minimum of 2 years of cash, 3 years of cash in some cases. So for them right now, our models are working because we're not touching our investments. We're not touching our stock investments or our bond investments. We're rebalancing and harvesting tax losses right now, and they're living off their cash. So new retiree right now would be live off your cash, use your cash. If the planning that you didn't account for you having a couple of years of cash, then if you need cash to live on, then I would skew my redemptions to the bond side, and short-term bonds is where I'm pulling money from right now for clients if they're in that situation. That's what I would say to do.
Yeah, and zooming out, I think you glossed over a bit kind of how you think about money, not only for retirees, but also kind of how we think about money in general, which is in those buckets of need. And I think that's a helpful mindset to have right now. I think when we're looking at the stock market, we should be invested in that for the long term anyway. If you're invested in an index fund, if you're invested in equities in general, that should be long-term money, and having those other buckets of money, especially if you're close to retirement, having that bucket of cash sufficient to cover a couple years, having that intermediate money and stuff safe enough to get it to cash within 5 or 10 years, and then having that long-term money in those separate buckets, I think helps from a mindset standpoint. People are fretting over money that they should have long-term, and long-term, I don't think anyone expects this to exist forever. I know we have the stock market sort of doing this, and when it's going down, you forget that over the long run, it's always been up and to the right. If we're looking at 10, 20, 30 years, the stock market has always added value. And that's how that bucket of money in equity should be thought of. So I think that sort of planning exercise that you just talked about, or how you plan for new retirees, really applies broadly to how folks should be thinking about what's at risk.
Yeah.
Yeah.
Yeah, it reminds me of a quick saying that I like, and I'll read it. It says, when you have the price, you don't have the proof. And when you have the proof, you no longer have the price. So we don't know what the next 6 weeks are going to bring, or next 3 weeks. Anything you read is a guess, but we kind of know we have the price right now.
Yeah. So one of the things that we talked about at the beginning, because I don't want to gloss over the fact that there might be some people who are looking for resources related to the stimulus package. And I mean, we're talking right now about managing money that people have, but if people are looking to go get money, there's a lot of individuals and businesses that are included in this stimulus package that are not necessarily accustomed to getting aid from the government. There are some businesses that expect to retain all their employees, expect to meet all their expenses, independent contractors in that same bucket who may be eligible for the payroll protection program under the CARES Act. I would encourage anyone who's working. There's a lot of gig economy workers. There's a lot of people who are working as independent contractors right now who may be eligible for some of those funds that will sort of keep you going. The same thing with what they're called the EIDL funds, that there's an emergency grant up to $10,000 that's available in a pretty quick process where the money comes pretty quick under the CARES Act. This is all the stimulus package that came out around Corona. We're talking right now about investment, but if folks are looking for resources, I would encourage everyone to make sure that you've gone down the full checklist of who's included in that package, and are not leaving any kind of free money on the table, or money that may be available to you that you do not know on the table. Same thing goes for individuals. There's a ton of unemployment benefits, and there's a ton of kind of payroll benefits that are in here for individuals, or to benefit individuals that you may not be aware of. And like I said, there's a ton of resources out here. I've been posting some stuff on my LinkedIn page, helping a lot of our business owner clients sort through some of the noise, but there's similar provisions for individuals. So if you are looking for resources and cash flow is an issue, be sure to go down that stimulus checklist.
Yeah, and the one thing that I'd add to there is I'd say, from a business owner standpoint, if the money is really easy to get, it's probably a loan. It's probably not a grant. It's something that you're going to have to pay back. If you have to go through the process of going to your banker, talking to your banker, filling out all the paperwork, proving what your payroll is, going through that whole process, that is where the money would turn into a grant basically and be forgiven, as long as it's used for basically four essential things. So just that's what I would say. If it's really quick and really easy to get, it's probably not money that's going to be forgiven. It's just a loan.
Cool. Let me see if any more questions kind of coming through on YouTube here.
I don't see any more.
Yeah, that's all I see.
That's all I see.
Shoot us any questions within the next few minutes here. We don't want to take too much of your time, but if no more questions come through, I'll let Jim give some kind of closing thoughts, and I'll give a closing thought, a minute or two. But yeah, stay safe, stay sane, stay invested. What do you think, Jim?
Spend time with your family.
Right.
Enjoy these times, right? Like, I mean that in the most sincere way. I know that it's different out there right now, but like in the end of it, like there will be some gifts that were given to us that, and I truly believe that we will be okay. I think we'll come out of this okay. And if you guys have any other questions, don't hesitate to ask.
Yeah, that's I'll piggyback on you and close with we talked a lot about how the first thing to happen was this indiscriminate sell-off, and then now you're starting to see winners from a stock market standpoint emerge selectively. I think the people who are looking forward to the post Corona world and sort of looking forward to who they want to be, whether that's investing money or whether that's investing resources in themselves and kind of leaning into what the world looks like after all of this, and staying focused on that are going to emerge winners from this. So do that.
Love it.
Courtney.
You know, a final thought just came in on YouTube. St. Mary's would have won March Madness this year. Just saying. For sure. It's a fact. It's a fact. Yep. That got us a Gale. Thank you guys so much for spending your lunch break with us today. I think there was a lot of great information covered, and this will be out there. It'll be up on our YouTube page so people can access it later as well. When quarantine is over, I will bring you guys a big box of Gale swag for you as a thank you. Until then, we'll just have to have our best wishes and verbal thanks for being here and spending, yes, virtual elbow tap there. Thank you guys so much. Stay safe and healthy. Oh, I like that, Toussaint. Yes.
Thank you for giving me a reason to shower and put on a button-up shirt. That was awesome.
Me too. I got ready today, and all those memes I've been seeing that said the best way to start your work from home day is to get ready for the day. I learned today that is accurate.
Yes. All right. Thank you so much. Appreciate it.
Thanks everybody for watching.
Thanks everyone. Appreciate it.
Bye.